In the last 6 months, Zoom stock has actually started to earn some pretty decent returns. But if we look at the last 5 years, we can see that the stock has barely moved. And what's interesting about this stock is that there's all kinds of very bearish and very bullish cases. For example, Kathy Wood from ARK Funds said that the stock would reach a value of $1,500 per share by 2026. Now she actually sold her position in the stock, leaving a lot of people wondering what is the actual accurate price prediction for this particular company. After days of hard researching this particular stock, I'm going to share with you the 2 different scenarios that I think are most likely when it comes to this particular stock and how you can benefit from each of those predictions. One big factor that's taken into account when it comes to my price prediction for Zoom is the fact that right now the company is a market leader. So as you can see right here, they have a 55% market share in the video conferencing software space, which is their bread and butter. They do have some other services, but this is the main thing that drives all the revenue and the profits. And the concern here is that these different solutions are getting better, specifically Microsoft Teams is being very competitive, and then Google Meet is also becoming more and more popular. But this breaks down into 2 different categories that are key to understand in my price prediction. So when it comes to company communications, there's 2 types of communications that you can have. You can have internal communications and external communications. Internal communications are the ones where you're talking with your own colleagues or the people inside of your organization that you're working for. External communications is when you're talking to people outside of your own organization. Now, the thing is that based on my research, I found that Zoom is really well positioned in the external communication space, which is great. But the problem is that the more lucrative space is the internal communications. And this is where Google Meet and Microsoft Teams are gaining more and more market share because they're already plugged into the tools that we use every single day, which is obviously the Office suite of products, and then for Google, their suite of products, Google Docs, Slides, Calendar, etc. And the thing is, my concern is that as the habit of using Microsoft Teams and Google Meet strengthens for people because it's being used so much in internal communications, then the external communications kind of become irrelevant because people become so used to these different communications that then they forget about Zoom, and they're like, if we're already paying for Microsoft Office tools and we're already paying for Gmail and all these other Google tools, why are we now paying for Zoom? Now, for certain companies that really rely on external communications, this is a great solution because Zoom is simple to use, it works really well, and it doesn't lock in an external user into an ecosystem for Microsoft or Google. So it is the right choice for these people. But it is concerning that more and more people will gravitate towards the internal communications, which will decrease their market share over time. Now, the one thing that does help Zoom is the fact that they have a lot of patents. So as you can see right now, 63 patents globally. And those patents, they do help with making the video conferencing experience much better. But the thing is, because we're talking about a software company, it's not easy, but there's ways to get around the patents that still enable you to have a very competent technology, especially when you have a lot of money to spend on these issues like Google and Microsoft do, and when you have a lucrative space that is the video conferencing market. So that is the problem, the fact that the company does not really have too strong of a moat to plug into to keep the competitors away from taking market share. One thing that is great about Zoom is the fact that it's in a very lucrative market. So as you can see right now, the market at this particular point is estimated to be around this amount, 10 billion in 2020. 2023, and it is expected to grow at a pretty high rate, which is 9.4% CAGR from 2024 to 2030. And this is really growing due to the different emphasis and the new trend that's taking place in the marketplace, where a lot of workplaces are now being hybrid, which means you can work from home or you can also work on premise at the office. And so when you have situations like that, it is key to have good video conferencing software that allows you to communicate with your coworkers and external people. So this is great for Zoom. And the other thing that's interesting is the fact that the large enterprise market is the largest, most lucrative segment of this particular market. And Zoom is really well positioned to take advantage of this, because large enterprises, they want solutions that are very secure, that are already integrated and have the best possible experience with Zoom's patents and experience in the space, plus the fact that people are used to it. The company is well positioned to take advantage of this and continue to grow in this segment. And this is all taken into account when we do the price prediction. Now, when it comes to the price prediction, there's two different versions that I think, in two different scenarios that are very likely to happen. So I'm going to show you scenario one, and then we're going to go into scenario two. So as you can see, this is my model, and this one is based on the P ratio and the revenue growth of the company. For the revenue growth, we selected this growth rate based on the market rate and the fact that there's likely to be some decrease in the market share of the company due to the strength of the competitors from Microsoft and Google Meet. As you can see, we have the revenue here, we have the projections right here of what that's going to look like. And then we have a net income percentage. Now, before I show you those numbers, I just want to show you the justification for those. So first, when it comes to the P ratio, I did the analysis for this particular company through Y-Sheets, where you can see I'm using these different formulas to be able to retrieve the data. So first things first, we have the P ratio, which you can see right now, and I'm calculating this using Y-Sheets formula. This is an add-on that you can download for Excel and Google Sheets to be able to retrieve data automatically. So in this case, we're just selecting the ticker Zoom, we're selecting this data, and we're selecting it for these different periods. This is going to give us the annual data. Now for the P ratio, you can see that it fluctuates quite a bit. So in this case, we have 24, 30, 214, 33, 161, 704, 2000. And then we also have negative numbers because the company was losing money. Now, when it comes to looking at the P ratio on a quarterly basis, again, this is all data from Y-Sheets. We can see that it fluctuates usually around 21, 21, 16, 32, 30, 294, etc., etc. So it is important to keep in mind. Now, for my prediction on the base case, I have a terminal P of 17. You can also do 20, but I did 17 due to the fact of the slowing revenue growth and the fact that the company does not have that strong of a moat. That's really a concern in this case. So I think 17 is pretty reasonable. Now, the other thing to note is the net income percentage that we use right now. So for that, what I did, I just went right here on Y-Sheets. You can just type in the company ticker. So in this case, this will be it. Select annual data, click on get data. And what's going to happen is that you're going to get all this information that you can see on my spreadsheet. So we have the balance sheet, the cash flow, key metrics, financial growth, etc. In this case, I really focused on all of the different statements to make sure that the company had a good financial health and that it was sustainable over the long term, which it does locally. But one of the main things was assessing also the revenue growth, which is taking into account for the revenue growth prediction, and the net income ratio. So as you can see, it goes from 14 to 2% to 33 to 25, etc., etc. So to have it at 18%, I think it might be on the high end, but I think it's conservative and doable for the company, especially as it matures. So this is why I have this ratio. Now, when we take the growing revenue with the projected net income, we can just multiply this by the terminal P ratio. So this is how much the company would be worth in 2029. We discount this at a rate of 15%, which I think is pretty reasonable given the current interest rates. And this gives us a price per share of $34. Currently, if I refresh this data is coming from Y-Sheets to give me the real-time information. The stock price is $68.60. So this represents a downside of negative 49%, which is not ideal. And as you can see for this scenario, I've also modeled different possibilities. So if the company has 5% growth, 10, 15, 20, 25, and if the PE ratio is higher or lower than what we had projected, what we can see is that the only scenario where we're able to generate any profit is if the company grows at a revenue of 25% with the PE ratio of 20, which I think is going to be difficult to do. Now, there's one more scenario that is also likely and brings the stock higher. So let me walk you through that scenario. This is the scenario where the company gets acquired by another big giant in the space, in the software, perhaps Adobe or perhaps another one of these software companies that are already pretty deeply integrated into the enterprise software world, and they want to add video conferencing to their suite of products. So in this case, what would happen is they would buy Zoom to take all of their technology, all of those resources, all their client base, integrate into their suite of products, so that way they can be more competitive and add more value to the company that is acquiring Zoom. In that scenario, we have again the same kind of revenue growth. I think the acquisition would happen somewhere maybe 2027, 2028, maybe 2029. It depends how the company is doing and the interest of the other companies, of course. So I kept the revenue growth the same, but here we used a different terminal value, and here we use the price to sales, which is usually what is used to determine when companies are sold for, specifically software companies. So in this case, we would take a multiple of 4 times the sales. So I'm assuming in this case we sell in 2029, 4 times the sales that we have projected would lead to this amount. If we discount it again by the 15%, we would get a price per share of $45. Right now the stock is trading at 68 like we saw before, and so this would still represent a downside of 33%, which is why I don't think it's a good idea to buy Zoom stock at this price point anyways. And as you can see in the analysis that we did here, we also looked at the price to sales ratio, and as you can see, if 4 is super justifiable. They might even do a 4.5 or 5 just because the acquiring companies usually has to pay a premium, but as you can see, this number is very reasonable and also scenario that's likely to happen. The other thing that would trigger this kind of scenario is the fact that Zoom has a lot of really high-level tech talent. So the CEO is incredibly impressive when it comes to this particular space, having worked and developed the solutions from WebEx in the past and then creating this company that we now know as Zoom. And then they also have a whole bunch of talent from Microsoft, Meta, Amazon, etc. that they've used to create the technologies that we know of today. So in conclusion, Zoom is a great company. The company has a great market, excellent management team. The company health is really good as well, and the product is pretty good as well. The concerns are the moat that the company has and the strength of the competitors in the space that just seems to be growing. And of course, the valuation, which this concerns is hard to be very optimistic about the stock, which also has an impact on the price that we should be able to pay as rational investors. Therefore, I estimate that the price per share is somewhere between $45.60 and $34 per share, which at the current stock price would be loss and something that I would not recommend that you invest. If you've enjoyed this video, make sure to subscribe to the channel, leave a like on the video, and comment what stock you would like to see next. And I'll see you in the next one.